Margareta went out shopping, bought a pair of nylon stockings, ripped them on her fingernail, and threw them in the garbage pail. But GDP's rising, GDP's rising, bye, bye, bye. Dollars in the sky, la 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 la. Hey!
Hello there, today we're going to talk about real GDP. Now, why do we need real GDP? What's wrong with just GDP? Well, remember from the last lesson we learned what GDP is. It's the market value of all final goods and services produced in a country in a year. Here it is in math. GDP is a sum of goods for goods I to N of the quantity of good I times the price of good I. So it's going to be the sum of the price times quantity of every good produced in the economy, every good and service. And what it gives us is the market value of all production. There's going to be a problem with this, so hopefully you can realize this pretty easily with me. Generally, we're interested in GDP going up. That means we have more production, more stuff. But no, GDP can increase if quantities of goods go up while prices stay the same. GDP could also increase if quantities went up but prices went up as well. In fact, GDP would increase even more. Finally, GDP can increase if prices go up even if quantities stay the same. Or even if prices go up a lot and quantities go down a little bit, GDP can go up. Well, we don't care about prices going up. In fact, in an ideal world, there wouldn't be prices because there wouldn't be scarcity. Every good would be free. It wouldn't be economic, and we could spend all of our time on the beach listening to Kenny Chesney and drinking Corona. Okay? We wouldn't even have economics. We wouldn't have work. We wouldn't have to produce. Okay? What we're interested in is not prices per se. We like prices because what they do for us in guiding the activities of entrepreneurs and helping us make decisions as consumers, so on and so forth, everything we learned about in Unit 1. But what we really care about as far as the production of goods is quantities. We want more. More is preferred to less. Okay. Well, GDP can go up even if quantities don't go up. So GDP by itself, pure GDP, or what we'll call here nominal GDP, is going to be an insufficient tool. Okay. What we have to do is refine GDP to factor out the price changes, or at least control for the price changes, and so we know when GDP changes, it was based on the quantities changing. Okay, and what this is going to be is real GDP. Okay, let me go right into an example. Let's calculate GDP for a simple small economy, which I like to call Macroville. And this is a place I would like to live in because there's only 3 goods produced in this economy: pizza, beer, and cigars. And for simplicity, we'll assume that all pizzas are the same exact quality, the same exact kind, same with beer, same with cigars. Of course, in reality, you have thousands of kinds of pizzas and probably tens of thousands of different beers. You have microbrews, you have the domestic swill, so on and so forth. You have thousands of cigars. And real GDP would add up the price times quantity of every kind of pizza, of every kind of beer, of every kind of cigar. But in our simple little economy here, so we can actually run the numbers, we'll just have one kind, only 3 goods, one kind of each. And what we're going to do here is calculate GDP. So notice I've got for the year 2010, I've got the quantities and prices. So I've got the goods listed here, pizza, beer, and cigars. I've got the quantity for 2010 and the price for 2010. So in 2010 we had 500 pizzas produced, each sold for $8. In 2010 we had 1,000, say 6-packs of beer produced, and each one was sold for $4. And we had 200 boxes of cigars, and each one sold for $10. Let's calculate GDP. We'll do that over here in this column, which I've labeled total market value of each good for 2010. That's the price times the quantity. And of course, the market value of pizza is 500 times $8, $4,000. The market value of beer is 1,000 packs times $4 is $4,000. Market value of cigars, 200 boxes times $10 each, $2,000. Add up all the market value. That's the sum of the market value. Okay. I know that mathematical notation might look a little tricky, but that's all this means. That's the sum of every one of these price times quantity calculations, and that's what we get right here, $10,000. So GDP in Macroville for the year 2010 is $10,000. Okay, easy enough, right? Now, GDP, a single GDP number is useless. GDP is used to compare either growth in an economy over time or the standard of living, the level of production across economies. We'll get into that here in the next lesson. So let's make a comparison in Macroville over time, and let's do the quantities and prices of these goods in 2011. Okay, and I'll code this in red. So in 2011 we produced 400 pizzas in Macroville, and each one sold for $12. We produced 800 beer, 6-packs of beer, and each one sold for $5. And we stayed at 200 boxes of cigars, and each one sells for $11. Now let's do the total market value. Now let's do the total market value for each good in 2011. 400 pizzas times $12 each. We've got 4,800 worth of pizza, 800 6-packs of beer times $5 each. We've got 4,000 worth of beer and 200 boxes of cigars times 11 each. We've got 2,200 worth of cigars. Add it all up, sum of price times quantity for each, and we've got GDP of $11,000. Hey, GDP went up, right? And let's calculate the percentage change there. Hopefully you know how to do that. If you don't, check out my tutorial on that. But we subtract this number from this number, divide it by this number. It's 1,000 divided by 10,000. You can clearly see that's a 10% increase. And the peasants rejoice because GDP went up. Woohoo! But not so fast. Not so fast. Notice, why did GDP go up? Okay. Is it because quantities went up? We had 500 pizzas in 2010. Now we only have 400. Okay. We had 1,000 packs of beer in 2010. Now we only have 800. We've got the same amount of cigars, but we have less available of 2 out of the 3 goods, and none of the goods do we have more available. Quantities either stayed the same or went down across the board. That means the only reason GDP went up is because prices went up to a greater extent than quantities went down. Okay. This GDP growth is strictly driven by increasing prices. And you'll notice increasing prices for all goods here, something that you might know about already. It's called inflation. We'll talk a lot about that later on. Okay. This is an inflation-induced or just strictly price-induced change in GDP. It's actually bad news. No! Okay, so this brings us to the real GDP concept. What we want to do with real GDP to factor out that change that's caused by strictly price increases or price changes is take the market value of all final goods and services produced in a country in a year, expressed in constant purchasing power terms, or in other words, holding the prices constant. Okay. You could also say adjusting for inflation. Sometimes it's deflation. In our experience, it's normally going to be inflation. Okay. Adjusting for price level changes. This is what real GDP means. Okay. You can think about it in any of these ways. Just the market value of all goods expressed in constant purchasing power. It's the market value of all goods holding prices constant. The market value of all goods adjusted for inflation. Okay. That's real GDP. Now, what's nominal GDP? Well, that's the old GDP that we just did up here. This is nominal GDP. Nominal GDP for 2010 is price times quantity of goods in 2010 dollars. Okay, 10,000 bucks. Nominal GDP for 2011 is price times quantity in 2011. Okay, so this is nominal GDP for 2010, and this is nominal GDP in GDP for 2011. So that's what nominal GDP means. Unadjusted, that year's output at that year's prices. Let's go back to Macroville and calculate real GDP. Now, what I'm going to do here, notice the change I've made to the market value column. I said the market value of 2010 output, base 2010, or in 2010 dollars. Okay, that's what this means here. You'll probably see it in the textbook or in news reports and in books expressed in this term $2010. That means in 2010 prices. Holding prices constant at the 2010 level. Well, what is that? That's $8 per pizza, $4 per 6-pack, and $10 per box of cigars. Okay. Well, shoot, we already did that for 2010, didn't we? We already did 2010 at 2010 prices, 2010 output at 2010 prices. That was 2010's nominal GDP. For its own year, nominal GDP will equal real GDP. So nominal GDP for 2010 equals real GDP for 2010 expressed in 2010 dollars. So this is already real GDP for 2010. We don't have to calculate that again. What we'll have to do though when we look at 2011 output, the market value of 2011 output, based in 2010 price levels, okay, your 2010 dollars right here, I'll throw back in the 2010 quantities and prices, but what we're going to do now is say we don't want to use the 2011 prices. We want to factor out that price change. Okay, so let's get rid of the 2011 prices and let's multiply the 2011 quantities times the 2010 prices. And I'm going to code this now in blue. And when we take 2011 quantities times 2010 prices, what we're going to get is 2011 real GDP in terms of 2010 prices, or 2010 dollars. And we'll do this calculation, which is now in the blue numbers. 400 pizzas produced in 2011 times $8 each at the 2010 price or value. So we've got 3,200 worth of pizza in 2011 at 2010 prices. 800 packs of beer times the 2010 price of 4, we've got 3,200 worth of beer in 2010 prices. Okay, 200 boxes of cigars times $10, we've got 2,000 worth of cigars. Add that all up, we've got a real GDP for 2011 in terms of 2010 dollars. I like to say the base year, okay, base year 2010, of only $8,400. And now when we do the percentage change, it's going to be minus 1,600 divided by 10,000. Quick, do that percentage in your head. 16%. Minus 16%. Okay. We've got a decline in real GDP of minus 16%, a much more disappointing result than that nominal GDP change of plus 10%. Okay. The plus 10% GDP figure was totally misleading, because it didn't factor out the price changes. This factors out the price changes, this holds prices constant, and this allows us to see the decline in the overall value because quantities for most of these goods went down. Okay, that's one way to do it. Now, what's another way? Well, we could base it in 2011. Okay, we could actually base a GDP, real GDP for any year in the price level of any year. Okay, any year. We could do it from the first year of the series we're interested in. We could do it for the last year of the series we're interested in. We could do it in the middle year of the series we're interested in. Okay. Let's do it here for the last year of the series. This is only a 2-year series and a 3-good economy, so it's really easy. I'll run you through this really quick. Let's do real GDP in 2011 dollars. Okay, and this is what we're doing here. Now, remember 2010's nominal GDP. Let me come back here for a second. 2010's nominal GDP is 2010's real GDP in terms of 2010 dollars. So I'll say in GDP equals real GDP base 2010, $ 2010. Well, likewise for 2011, nominal GDP for 2011, which is what we did initially, is also real GDP for 2011. Okay, because that's already in 2011's prices, so we don't need to recalculate that. What we'll do this time is take the 2010 quantities, the 2010 output here, times the 2011 prices here. So now we're going to forget about all this stuff here, and we're going to do the 2010 quantities times the 2011 prices. 500 pizzas at $12 each is 6,000 worth of pizza. 2010 quantities in terms of 2011 values. Okay, 1,000 6-packs of beer at $5 each, 5,000 worth of beer. 200 boxes of cigars at 11, 2,200 worth of cigars. Add that all up. Okay, real GDP of 13,200 in 2010, base year 2011, price level of 2011. And we'll do the percent change to compare our growth rate, and we see it's going to be a similar result. You won't ever see the result exactly the same when you use a different base year, but you'll see it's going to be pretty close. Okay. When we use 2010, let me jump back to 2010 as the base year, we saw a 16% decline. When we use 2011 as the base year, we'll see a 16.7% decline. A little bit larger percentage decline because we're using a higher scale of prices. Okay, but we see it's a similar level. Okay, and we get the understanding that GDP declined significantly. Real GDP declined significantly in both cases. Okay, so that's how we do real GDP. Now, of course, for the actual U.S. economy, there's millions of goods and services, and it's a big task to do. Fortunately, we have a reliable statistics, economic data gathering bureaucracy in the Bureau of Economic Analysis, and they calculate nominal and real GDP in a fairly trustworthy manner, I would suggest, for the U.S. economy. And so we'll just go to that data. And what I have here is going back to 1940s or so. Nominal GDP, which is just gross domestic product, that's the blue line, nominal GDP, and then real GDP. Real gross domestic product for the U.S. economy going back 60 years or so. And you'll notice that because there's been what's happened to prices over time, you're probably aware of this, the general trend of prices of all goods is to go up. That doesn't have to be the case, but that has been the case over this time period in the U.S. So there has been a general inflation of prices, okay, which means nominal GDP will rise faster, and you'll see it has a greater slope than real GDP. Real GDP, and by the way, you'll notice that if we go way back in time, nominal GDP at much lower prices would have been much lower, but when we adjust it to make it real, we put it into terms of more recent prices, which have gone up, we see that real GDP is higher. Farther back we go, generally the larger the difference percentage-wise. Now more recently, we've seen, hey, real GDP is less than nominal GDP. Okay, why is that? Well, that's because what year are we using for the base year? Let me ask you that. I won't tell you. Let me ask you, what year are we using for the base year here? It actually does say it on the graph if you look sharply, but you don't even need to have it labeled, because remember, it's the point at which nominal GDP equals real GDP, right here, right between 2000 and 2010, 2005. Hey, it does say that. Billions of chained 2005 dollars. So we're using 2005. 2005 is our, I like to call it the base year for prices. Okay. We could also say $ 2005. That would mean in dollars of purchasing power 2005 level. I'll get into the purchasing power concept in the next unit. Okay. But that's what's going on here. Okay, and this is the difference between nominal and real GDP. Now, when it comes to looking at growth, looking at the actual standard of living changes, comparing across countries, which do you think we're more interested in? Okay, of course we're more interested in real GDP when we make these comparisons. Now, does that mean nominal GDP is completely irrelevant? Actually, no, not at all. Nominal GDP, we're going to find much later in the course, is going to be very relevant and very useful for thinking about business cycle fluctuations. So we'll use nominal GDP, we'll use real GDP. Okay, you've got to understand the difference, you've got to understand how they're calculated. Hopefully now you do. Okay, and that's all there is to it. Now there's a few more quick things I want to address right now. And that is, I want to take a look at decomposing GDP into its components, both on the expenditure side and on the income side. Normally we're going to look at GDP in terms of what people buy. Okay, GDP is the market value of final goods and services produced in an economy in a year. Well, they have to be bought by consumers, and that's normally how they're going to be counted for the bulk of things. Of course, investment goods are purchased by companies. But we want to look at what individuals spend on consumption goods, what companies and businesses spend on investment goods, and what the government spends on both kinds of goods. Okay. So we'll take a look at GDP in terms of these expenditures accounts: consumption goods purchased by consumers, investment goods, also known as producer goods. This is capital. Government purchases, again, of both consumption and investment goods. The government feeds the military, that's consumption purchases. The government builds highways, that's investment purchases. And then net exports, which it's not hugely relevant right now, but that's just the difference between exports and imports. If America is exporting goods to foreign countries that's produced in the US, we want to count that. Goods that Americans consume that are produced overseas, do we want to count that in gross domestic product? The answer is no, because it's not produced domestically. So we need to subtract imports, we need to add in exports even though they're not consumed in the US. So we'll add the net exports in, and that's how we'll do GDP in terms of expenditures. And this is an equation that you'll want to become familiar with. This is just taking a look at GDP, which we use the variable y to denote GDP. Okay. The variable y denotes GDP. You can think of it more broadly as output. You can think of it as spending, real spending. You can think of it as total real goods produced. That's what y is. And on the expenditure side, well, y, total real goods production, total real spending, is composed of consumption spending, C, investment spending, I, government purchases, government consumption spending, and government investment spending. You want to note right now that that does not include what we call transfer payments. We'll come back and talk about that much later on, but this is just government actual purchases of goods and services and investment or capital products, and then net exports. Okay, now I just bring this up because this is a way to think about GDP that we're going to use quite a bit later on in the course. We won't use this right now, but I want to introduce it right now because it's a way to break down the GDP number. And there's one more thing we'll look at, which is the incomes approach. We can think about GDP in terms of income because every dollar that somebody spends on a consumption or investment good, that's a dollar they're spending, but it's a dollar of somebody else's income. So we can think of GDP in terms of expenditures. We can also think about GDP. The exact same GDP number can be represented in the incomes accounts, and we're going to have 4 of these as well, just coincidentally. Wages, which is a payment to the labor input. Interest, payment to the capital input. Rent, generally think of this as a payment to a land input, or actually any kind of fixed asset This could actually be a capital payment as well, but any payments to fixed assets that are used to produce goods. And then profit, which is payment to the entrepreneur. Some economists like to say profit is the cost of the entrepreneur. I don't know if that's the most useful way to think about it, but you can definitely think about profit as the payment for the entrepreneur services in organizing all these other factors of production. And by the way, do you recognize these factors? Land, labor, and capital. Of course, those are your classical factors, which hopefully you learned about in micro. If you didn't, I've already talked about them quite a bit in this class. Okay, classical factors of production. Actually, the classical economists didn't have entrepreneurship. That's something we've added in more recently. But we're looking at the earnings, how we categorize and classify the earnings of the factors of production. Land, labor, capital, entrepreneurship. We've got wages, interest, rent, and profit. Let me show you the equation here. Again, we'll use this later on a bit in the course, but I want to show it to you now because Y is GDP. Remember before we thought about it as expenditures or real spending, real purchases. Now we can think about it as real income. And that's composed of the income that goes to labor inputs, the income that goes to capital, the income that goes to land and fixed assets, and then the income that goes to entrepreneurs. Ways of thinking about GDP that will be very useful in kind of organizing and analyzing and thinking about how the economy works. Okay. So that's the only reason we'll cover these now. These are just kind of something to put in your back pocket, and we'll make reference to them at various times throughout the entire course. Okay, so that's it for the real GDP concept. Next time we'll take a look at, we'll actually use GDP. We're going to break out some GDP numbers, compare wealth of nations across different countries using real per capita GDP numbers. We'll talk about economic growth within a country, looking at real GDP growth rates. And we'll actually we'll make some practical use of this real GDP concept. See you then.
Johann bought a brand new car and celebrated at the bar and drove his car into a tree. That's good for the economy because GDP's rising. GDP's rising. Bye, bye, bye. Dollars in the sky.